Big news for the banking industry today as the U.S. House and Senate finally reached a compromise agreement on how to regulate the financial services industry. We've been looking hard at how this is going to affect bank profits all morning long. One person who ought to have a good idea is Bill Winters. He's the former co-CEO of JPMorgan's investment bank and earlier this month was named a member of an independent commission on banking here in the UK that will report to Finance Minister George Osborne. Chancellor of the Exchequer is what they call him over here, but we're just trying to translate for you. Bill, wonderful to have you. It is no understatement that what we're seeing today, the compromise agreement, represents the biggest overhaul in financial services regulation in 70 years.
No doubt.
Is Barney Frank right that this is a stronger bill than maybe what we might have seen yesterday and certainly what we would have seen a week ago?
I guess it's a stronger bill than what we might have seen yesterday and maybe a week ago. It's certainly a strong bill. There's a lot in that. Always a little bit concerning when the sorts of compromises that we've seen overnight happen in a rush. So we can all hope that they've thought through details. But certainly the gist of this is it's substantive. It will make a difference. It will have an impact on the banks for some time to come. And it's at the same time nowhere near as bad as what the banks might have feared as recently as a week ago.
Okay, so let's try to game out the winners and losers here, either by business, by institution. I mean, who got something out of these last-minute negotiations and who lost?
Well, I think as is the case in these sorts of negotiations always, everybody got something and everybody had to give something up. So I think some of the worst case outcomes for banks in terms of derivatives, for example, seem to have been avoided. But nevertheless, the implications of this bill seem to be quite substantive for the banks, particularly for their non-interest rate and currency-related derivative activities. But I think banks had pretty well factored in already the idea that most derivatives would, if not all derivatives, would end up being cleared through a central clearing counterparty. And I think the banks have supported that thrust. So not a huge surprise, and probably not a huge cost either.
How about the compromise reached on the Volcker rule? On the one half, you have this 3% provision, let's call it. No more than 3% of any fund's capital can be supplied by the banks, and they can't invest more than 3% of Tier 1 capital in private equity and hedge funds. And then the ban on prop trading, it's there. There's a stricter definition for it. How negative is this going to impact bank profits?
I don't think it'll have any impact at all on most banks. I think it's a very pragmatic resolution. It's saying the banks can't push the boat out and really risk their firms in these non-core activities to the extent that that's what they've been defined as. And at 3% of Tier 1 capital, that's a reasonable amount to be investing in something that isn't fundamentally banking or client-driven. And by the same token, it allows banks to seed funds or private equity funds where the primary purpose is to distribute an asset management vehicle. So I think it's a pragmatic solution that should result in the banks having no big issues.
How about the conflict of interest guidelines on asset-backed securitizations? A lot of people will applaud that. How about from a bank profitability standpoint?
I'm not sure that there's a huge bank profitability dimension here. I think that the real issue is how are we going to get consumer lending out of the central banks and the GSEs in the U.S. and into the banking sector or the capital markets. And I'm afraid nothing in this bill, at least from what I can see, makes that any more likely or any easier. In fact, I think it will be very hard to get central banks out of the consumer lending business.
Okay, Bill, when we come back after a break, we're going to talk about European banking. But one question I have to ask you with about 30 seconds to go. If the banks were ready for this, if all of these things really aren't going to add up to that much in terms of banking profits, it doesn't sound like it's a particularly strong bill.
Well, I think the punchline was always going to be the banks have to hold more capital than they were holding before. That's already been priced into every bank security price, and I think the conclusion of this U.S. process has been just that. Amongst other things, which are relatively small, the banks will be holding more capital. That makes the system safer and sounder and obviously reduces bank returns.